Okay, so when we met last week, we were at the point where we were discussing inflation, and in particular, I stopped at the point where we said the CPI is a weighted average of the prices, and what prices are we using here? And we asked the question, what would it cost a representative household to buy a basket of goods, right? And for that, obviously, we first have to talk to the household and say, how much of your budget do you spend on different items? What are the items that you spend on, and what is the percentage of your budget that you spend on those things? Once we have the quantities and the prices in the base year, we can use the prices of the current time period to calculate the CPI index, and we said that the CPI index calculates the following. The CPI index is a weighted average. This thing can be converted into weights, where the weights are the share of the household budget that is spent on an individual month. So to calculate the CPI index for any given time period, this is equal to here. We take the total spending by the household on different things in the base year, multiplied by the base year prices, and then for the current time period, we take the same basket of goods and value it at the current prices, and that gives us the CPI index. So we said that in Vietnam, a representative household spends almost 34% of its budget on food and foodstuffs, whereas in a country like the US, food becomes a smaller percentage of total spending, and a lot more is spent on other kinds of things. Different countries will have, and as a country becomes more advanced, the share of the budget spent on food tends to decline. So one day Vietnam is going to look like this, right? Where a low percentage, even now, right? I mean, you're spending more and more of your pocket money on other things besides you buy apps, all kinds of apps on your phone, right? You pay money for those apps. So let me not go into this. Let me not go into this. The only thing, well, there are different ways of calculating the CPI, and there is something called the Laspier's CPI index, where you compare the price of the current time period to where you keep the basket of goods as it was in the base time period. There is something called the Pash CPI index, where you calculate the amount that is spent not on the base year quantities, but on the current year quantities. Remember, we said that as countries change, as you are changing, the basket that you're spending your money on is changing. What your parents spent their money on, is very different from what you are spending your money on. So this is an index which takes into account the fact that the consumption basket can be changed. Here the consumption basket is kept fixed. Here the consumption basket is changing. And this usually tends to have a downward bias. This tends to have an upward bias. So if you take the average of these two, this is the geometric average, then the upward and the downward biases cancel out. And if you construct the CPI index and the geometric average of the Laspier's and the Pash index, you will get what is called the Fisher. The GDP deflator, again, is sometimes in our spreadsheet we calculate as is calculated as a Pash index. Remember, there's a difference between the CPI index and the GDP deflator. Why? Because the basket of goods and services that's included in the CPI index is different from the basket of goods and services that's included in the GDP. The GDP has many things in it, everything that's produced, including investment goods, but investment goods are not consumed by households. So the CPI is trying to capture the cost of buying a consumption basket by a representative household in a particular time period, because the GDP is consumption plus investment plus X minus M, and when you try to calculate the price of, you try to calculate real GDP, then you use the base year prices, the current quantities, and the current GDP is obviously calculated, current quantities, current prices, and the ratio of the nominal to the real GDP is the GDP deflator. So what are the key differences between the CPI and the GDP deflator? Quite often, when almost all countries produce a CPI index on a monthly basis, but the GDP cannot be calculated every month. There are very few countries that calculate the GDP on a monthly basis. Typically, the GDP data is slow to come out, and you can calculate GDP deflator only at a quarterly basis. And as I said, the CPI is trying to measure the prices of goods purchased by consumers. This is a consumption-based measure, whereas this is a measure that's reflecting production in the economy. Consumers consume domestically produced goods and imports. So there's an inclusion of the prices of imports in here, whereas the GDP is the value of final goods and services produced in the economy. So we have X minus M. So the M part drops out. This is a measure of prices of domestically produced goods. And the CPI, as we said, because it's a last year's index, most of the time tends to overstate the increase in the cost of living, and this tends to understate the increase in the cost of living. And typically, countries produce CPI as a last year's price index, whereas the GDP deflator is produced as a PASH. With a changing basket, in this case, the CPI, because it's mostly calculated last year's price index, it's a fixed basket of goods that's been used to calculate the CPI index month after month after month. Let's see how we can. So now that we know what the CPI index is, how it's constructed, let's talk about analyzing what information can we get out of the CPI index. First of all, we can calculate different measures of the CPI index. Well, once we have a CPI index, we can analyze it many different ways. Right? There is, of course, the monthly change. We can look at inflation month over month. We can also calculate the annual average. If you are interested in 2025 as a whole compared to 2024 as a whole, we will take the average of the CPI indices in 2025 divided by the average of the CPI indices for the 12 months of 2024, take one out and multiply by 100. So we're looking at the average of 12 months in 2025 compared to the average. So there are 12 numbers here and there are 12 numbers here. We're calculating the difference. We can also calculate the end of the year. We can look at December of 2025 compared to December of 2024. So we're comparing one number to one number. We can calculate a 12-month inflation rate. We don't have to necessarily calculate in December. In fact, we do want to know how prices are in this month compared to the same month last year. We can calculate the monthly, as I said, or we can calculate the quarterly. We can average the three numbers for the first quarter and compare the next quarter three numbers to the previous quarter. And finally, we can annualize the monthly inflation. So the inflation in the month of January if the same inflation takes place every month, February, March, April, up to December, what would that inflation rate be? So this is giving, so different things, this is giving a sense of the momentum of inflation. This is comparing 2 time periods. The 12-month inflation rate is also giving us a difference compared to 1 year ago. Remember that we said that the CPI probably has a lot of seasonality in it, because during debt, maybe the CPI index goes up quite a bit compared to December if debt falls in February, if debt falls in February compared to January. When March comes around, because the CPI index is already quite high because of debt, the CPI inflation in March may not be so high, or might actually be negative. Because after debt is finished, demand falls and prices might fall. So to take into account these monthly factors during the course of the year, we do a seasonal adjustment. What information can we get from the inflation data? Because we know that the CPI index is an aggregation of many things: food, non-food, food plus things that might be, food and clothing, energy. Because we have these different components, we can break down. We can look at what is happening to food separately or non-food separately. We can construct sub-indices out of the CPI index to see where the inflationary pressures are coming from. Sometimes the inflation is coming from food. Sometimes the inflation is coming from non-food items. Quite often the government has administered prices. For example, the schools in public, the fees in public schools. Those are not changed every month. They may be changed every year or every 2 years. So in the month that you see the change in the school fees, you will see a very large inflation in that particular month. But after that, the school fee is kept the same. After that, the percentage change, the school fee will be 0, 0, 0 until it's changed again. So there are some things that move a lot. Food prices will move every month, depending upon demand and supply. The demand and supply for education in public schools does not affect the price of the school fees. If more students want to come, the government does not necessarily raise the fees. So there are things that move a lot. There are things that do not move a lot. There are some things for which the price is determined by market demand and supply. There are others for which the prices are administered by the government, and therefore the prices do not change very frequently during the course of the year. So we want to understand what are the fast-moving components of the CPI index and what are the not so fast-moving components of the CPI index. We can also be interested in traded versus non-traded goods. Okay. School fees, transportation. If you want to take a Grab motorcycle in Vietnam, you cannot buy it in Thailand. When you rent a motorcycle in Thailand, you're renting a motorcycle in Thailand. Right? You cannot say, I'll rent a motorcycle in Thailand to go from one place to another in Ho Chi Minh. So there are traded goods, food is traded, rice is something that is on the international market, so that's a traded good. Some of the components of food and clothing, mobile phones, computers are traded items. Whereas if you go to a restaurant in Bangkok, that is, you cannot eat the same food in Bangkok. It's different. So restaurants is a non-traded good. So we may be interested in whether the inflation is coming from traded goods, if it's coming from outside the economy, because prices in Vietnam for traded goods are related to, or will have some relationship to, the prices of goods, of those goods in the international markets. But you can have a cup of Vietnamese coffee in Ho Chi Minh City, or you can have a cup of Vietnamese coffee in Bangkok. It's a traded good, it can move around. Starbucks. You can have the same Starbucks coffee at Hikari, or you can have the same Starbucks coffee in Ho Chi Minh City, or you can have it in Washington, D.C. So where is that inflation coming from? And how much of the inflation is coming from things that cannot be consumed, have to be consumed where they are produced and at the same time as they're produced. A very important construction that we have to analyze inflation is what is called core inflation. This is something that you might have seen in your other courses. The idea here is that just like we did seasonal adjustment to take out the impact of seasonality, there might be other ways to take out the impact of things that are too volatile, things that move around too much or move too much at some points of time. So you want to take out the impact of what are called volatile items from your CPI index. And again, it might be a matter of judgment, or you can have statistical measures to come to a decision that these are the items that are more volatile. When you take those volatile, and there are different ways of taking volatile items out of the CPI basket. And once you take those volatile items out, you can reconstruct the index, and that reconstructed index is what we call the core CPI index, and the change in that index is the core inflation. The purpose of doing that is to measure the underlying pressures in inflation that continue from one month to the other month after you've taken out these very volatile elements which are changing too much. Okay? We want to have a sense of what are the fundamental underlying inflationary pressures that continue from one month to the next month. So constructing these different measures of inflation, why are we doing that? First of all, it's telling us where the inflation is coming from. As a central banker, as a policymaker, tomorrow we work in the central bank and the governor says, why are we getting so much inflation? And your answer will be, I need to go back, think about it. And when you come back, you're going to do all of these calculations and saying, well, the prices of commodities in the global economy have increased a lot. The price of oil in the global economy has increased a lot. So many of the things, so it is inflation that is coming from outside. Or you might say restaurant eating has become much more expensive. Or in this month the government raised the fees for public schools, and that means that the source of inflation is domestic. Or the Grab taxi drivers are becoming, they are charging more all of a sudden because the prices of oil in the global economy have gone up. Right? So you will have to explain to the governor what the sources of the inflation is. In addition, you would like to inform the governor, well, these changes, the price, the next question says, well, do you expect these things to continue for a long time, or will it go away very quickly? Did something happen? And you will have to explain to the governor whether these things are transitory, which means that they come, but they go away in 2 months or 3 months, or whether these are things that will last for a long period of time. Transitory or permanent shocks. If there are, and that has important implications for policy. If it's something that's very transitory and will go away on its own, then you don't need to do very much about it. But if it's something that's a permanent shock, then maybe you have to take some action. That's the reason why we want to decompose that information on the CPI inflation and understand it in its various components. So what does that imply that you do? We analyze the percentage change for each component. Let's say we look at headline inflation, say this, so if CPI inflation was 2%, we want to break it down into how much came from food, how much came from clothing, how much came from education. education, how much on education, services, and different, right? And all of these components will add up to 2. It should, because you're breaking it down into the various. First, we take the percentage change, multiply it by the share in the CPI basket to get the contribution of that component to CPI inflation. Remember, we know how to do percent changes and contributions. We did that for GDP, and we did that in our files. Then we compute once we have the percentage changes component, we can calculate the contribution, whether food led to 1.5 of the 2%, or whether it was non-food that led to 1.5 of the 2%. So we break it up into 2. And remember that something can have a very large price change, but if its share in the CPI basket is small, its contribution will be small. If something has a large percentage change and there's a large share in the CPI basket, the product of those two things will be large, and therefore the contribution of that particular component to CPI inflation will be large. Keep in mind that there's 2 things that matter for the contribution: the percentage change in that particular component and the share of that component in the CPI basket. Both things are. At the same time, remember that inflation goes from month to month to month. It's not like there's inflation in 1 month and we stop calculating. There are some things, the impact of which can flow into other things. So let's say the price of rice goes up. Then the rice that you bring home to cook becomes more expensive. But also rice is used in the restaurant to cook. So if the price of rice goes up, the component of food will go up, but the component of food eaten outside the house will also go up. So the restaurant will have to charge you more. If the restaurant charges you more, it will show up in some other component of the CPI as well. So when we look at food, it may not fully give you an indication of the importance, and you have to think about what are the other things that are affected by oil. Okay. So if you look at oil, it affects many, many things. It will affect the price of food, because food, rice is produced in the field, it has to come to the city. All of a sudden, the price of food in your house, in your restaurant, has become more expensive. When you order delivery by Grab motorcycle, the price of oil has gone up. So the price of the delivery to you of the food that you order from the restaurant will also go up. So the price of oil is feeding into the price of oil, and it's also feeding into the price of the delivery. So there are multiple ways that one particular price change, or again what we call second round effects. So food becoming more expensive can make some services also more expensive, other components more expensive. If you were to draw a chart which breaks down the contributions of some goods to the CPI index, it would look something like this, where you would have, for example, food. This is the contribution of food. Transportation, including petrol. There's the gray areas. And non-food is this. Remember, the share of food in the CPI basket is how much? 34%. The price of these two things together is almost 67%. Therefore, in this particular chart, you see a large contribution from non-food and a smaller contribution from food. So and these are times when transportation became much more expensive. This is the time when transportation prices are falling. So the positive bar plus the minus, this is again the time when food prices are falling, because the blue charts are negative. this positive number plus this negative number gives you total CPI contribution. Here, everything makes a positive contribution, so red plus gray plus blue gives you the light blue. Clear? We could also have done this in terms of food and non-food. And if you did the breakdown into food and non-food, then you would see only, let's say the non-food was red, that all of these numbers would get included in this, and this chart would look later. Or we can have even a more detailed breakdown of the contribution of the different components. So again, what is the difference between headline inflation and core inflation? Headline inflation includes everything. We don't make any adjustment. The NSO gives us the CPI number. We basically calculate the percentage change in the CPI number, and we get the headline inflation for the month. But the core inflation is supposed to take out the impact of volatile items. The NSO does provide a measure of core inflation, I think year on year, but you could construct your own measure of core inflation as well. In general, in the US, for example, energy and food is considered to be volatile. Energy, because in the winter months, you have a lot more use of oil to heat houses. And during the summer months, you don't need that much oil to heat houses, electricity to heat houses. So the prices of energy in industrial countries are typically taken out of the CPI basket as a volatile item or a very seasonal item. Food can be very volatile. Some items in food in the US can be very volatile. And of course, the regulated prices, we do not change every month. They may not be dependent on demand and supply. And here you might include things like the cost of fees at schools, the price of a ticket on the local bus. That is in the hands of the government, can be changed. In general, as you might make a judgment about what is more volatile. You can either do a statistical analysis over some time period to see which component has a higher standard deviation, lower standard deviation. That way you get to measure something that's more volatile. But in general, there are many, many different ways of constructing measures of core inflation. And the construction of core inflation, what are the things that we want to take out completely? For purposes of forecasting, well, we know that if there are changes in taxes, now doing some of these things is hard and we're not going to do them, but it's good to know that this is what needs to be done. And depends. So once again, if you're constructing a measure of core inflation, it depends on what purpose you're going to use that measure of core inflation for. Okay? If your job is just to forecast inflation, you will take something out. But if you're going to make a decision in terms of policy, then some other things need to be taken out or not taken out. We won't go into a whole lot of detail, but it's important to know we construct measure of core. There is no single way of constructing a measure of core inflation, and constructing a measure of core inflation depends upon what purpose we are using it for. So if you look at the case of Vietnam over the last, let's say this is over 6 years, 7 years. The first thing that you notice is that in this chart, the red line is total CPI inflation. The blue line is food price inflation, and this is on a 12-month basis. The red line is always between the pink and the blue line. Why is that? Because headline inflation is a weighted average of food and non-food, and the weighted average will always lie between the two components. You can also see that the contribution to headline inflation is not the same all the time. There are time periods where food contributed a lot. There are time periods when food actually brought down inflationary pressures in the economy, and it was non-food items that were generating inflation. And somewhere here, food and non-food are just about contributing equally to inflation. So it's not the case that food and non-food contribute equally to CPI inflation at all times. And that's what we say. We can also consider, this is headline inflation. This is basically what the NSO gives us. We use those numbers, do a little bit of a decomposition. But we are also, and this is on a 12-month basis. So we're looking at December versus December, January versus January, February versus February. This is on a 12-month basis. Quite often we are interested not on what inflation was is today compared to 1 year ago, but we're interested in what the momentum of inflation is in the last couple of months. Because there is a lot of inertia in inflation. If inflation is high, it tends to remain high. When it's low, it tends to remain low. There is a lot of relationship between today's inflation and last period's inflation. So we are trying to look forward at inflation. We want to understand what is the momentum of inflation. And for that, we can construct either the core index, and this is on a 12-month basis, or we can construct the headline inflation. We take the last 3 months. Okay. What does the 3MMA SA mean? First of all, the SA means that we take the headline inflation and seasonally adjust it. So we take out the impact of TET from that series. The second thing we do is we take the 3-month average. Okay. So 3-month moving average. January, February, March, April, March, April, May. We take the average of those 3 months. So that's the average, seasonally adjusted average of 3 months of inflation. So it's giving us an idea of what is happening now, not what is happening now compared to 12 months ago. Okay. So this is the momentum of inflation. What are the underlying pressures now? Then we annualize it, okay, to find out if the same inflation that we have for these 3 months seasonally adjusted were to continue into the next year, what would inflation look like? Or what is the expected inflation going forward? And based on that, here, after we take out, so this is the time period where the momentum of inflation is coming down. This measure is telling us that. And this measure is also, in this time period, look at this. Both measures of inflation momentum are telling us that inflationary pressures are rising. This is again a time period, if you look at this roughly, this is telling you that inflationary pressures are rising. If you draw a straight line through this, that would also tell you that inflationary pressures are rising. And if you look at this time period, inflationary pressures are falling, inflationary pressures are falling. And here, inflationary pressures are rising, inflationary pressures are rising. So the construction of these different sorts of indices, looking at them carefully and making a judgment and interpreting them, gives us some idea of what inflationary pressures are, and as we will see during the rest of the day, it is an important thing to understand because we will base policies depending upon where inflation is going. If we are interested in economic stabilization, we want to keep inflation low. And as part of keeping inflation low, we have to anticipate or think forward as to what is happening today and what might happen tomorrow, and take policy actions based on that judgment. Clear? What determines inflation? Well, first of all, we can do the component analysis, and we can find out what is contributing more to inflation. And we can then also look at the underlying factors of inflation, identify the shocks that are pushing up prices, short-run, demand-side shocks, supply-side shocks, and we can also think about how inflation is moving through the economy, because as we said that there is inertia in inflation. If there's very high inflation, it tends to be high going forward, and the role of policy is to try and dampen down those pressures. What determines inflation in the long run? In the long run, we know that we make the assumption, or we assume that the economy is going to be at its potential, working at its potential level, so there is no slack. And the idea was put forward by Milton Friedman during the 1960s and 70s that in the end, inflation in the long run is a monetary phenomenon. And the inflation rate in the economy is determined by the growth of money. Countries which print too much money will have higher inflation. And countries which are much more restrained in their printing of money will have lower levels of inflation. And he basically captured this in terms of the quantity theory of money. And so basically the quantity theory of money basically says that there is a relationship between output and money and velocity. So this is something that you see before. This is the money stock. This is the velocity of money, and this, let's say, is nominal output of the economy. And all that is happening there is that has been rewritten as MV divided by Y. So the higher, and then after you convert it into logs, you can get the percent changes. So essentially it's saying that if an economy has very high rates of growth of money, in the end velocity is determined by institutional factors, and if the economy is at full level of employment, then there is so if this is a constant, so if we think of this as K times M, because this part in the long run constant, then there is a very strong relationship between the rate of growth of money and the rate of growth of prices. So in the long run, the rate of inflation in the economy is determined by the rate of growth of money. But why do we care about inflation in the short run? Because we're interested in stability as policy makers. We want inflation to be low and stable, because we know that high inflation makes it difficult to make economic decisions. But we also know that temporary shocks can lead to high inflation Once it starts, because there's a lot of inertia, and this is something that I said, if the price of oil goes up, the cost of production goes up. If the cost of production goes up, then suppliers have to raise the prices of goods that they sell. If the prices of goods that they sell, then the labor which is consuming those goods may ask for higher wages. If there's higher wages, labor cost goes up. If the cost of labor goes up, then the prices of the goods will again go up. So you can have situations where inflation becomes a spiral. So an initial temporary shock can lead to the first round impact on inflation up till here. But then there can be a second round of inflation because that inflation feeds into the labor market, and pressures from the labor market come back into the goods market. Also, if inflation is high, then if it stays high, then everybody will expect higher inflation. If I'm expecting the price of my inputs to go high, then I will raise my prices even further, anticipating that because my inputs are going to become more expensive, I will need to sell them at a higher price. So we want to have a situation where inflation does not get out of hand. We also want to maintain a situation where if there is a first round effect of an external shock, for example, on inflation, it does not feed back into inflation, or we want to control the second round effects. And therefore, policy action has to be taken in terms of monetary policy to stop that from happening. So based on that discussion, what are the kinds of things that affect inflation in the short run? Of course, we said yesterday's inflation or last month's inflation, expectations going forward. There are, of course, the demand and supply pressures, prices that determine market. If the VAT rate goes up, prices will go up higher than they would have without the rate increase in VAT. Indirect taxes. In your DSGE models, you looked at the demand, the supply side is characterized by oligopolistic firms. If there are fewer oligopolistic firms, there will be more market power. More market power means that firms have the ability to raise prices more than if there was perfect competition. The market structure has an impact on inflation as well. And finally, besides the domestic pressures for inflation, there are these external factors that affect inflation, the prices of imported goods, commodity prices, and very importantly, exchange rate. If the exchange rate goes from 25,000 VND to the dollar to 26,000 VND per dollar, everything that you were importing, which used to cost $1, and it cost 25,000 VND, will now cost 26,000 VND. That is going to change. This is something, and that is captured basically in the Phillips curve that you've seen before, where inflation depends upon expectations of inflation and the output gap in the economy, which captures the demand and supply pressures. We could also add pi t minus 1 before this, which would capture the inertia, so that inflation today depends upon yesterday's inflation. That would capture past inflation. And when you have a microstructure, then you would have a supply curve in which the real marginal cost of firm will enter as a variable on the supply side. So the Phillips curve that you've seen in your DSGE models, or the aggregate demand curve that you've seen in your DSGE models, is basically capturing the basic ideas of the determinants of inflation from the demand side. this brings you back to your more complicated life in DSP models, right? Something very simple, not very complicated all of a sudden. Intertemporal optimization, household intertemporal consumption behavior, all of that is all of that is. So what is the role of inflation expectations? If the expectation that inflation will be low, then today's inflation will be low. Right? So given alpha, if the expectation of inflation is low, then current inflation is supposed to be low. But what determines expectations? Of course, recent inflation, which the fancy name for that is adaptive expectations. So people are forming their expectations of inflation based on what inflation has been in the past. If they've seen high inflation, they will expect high inflation. Another thing that affects the expectation of inflation is how credible the central bank is. Right? If everybody knows that this is a very, very strong central bank which is very committed to keeping inflation down, and if inflation goes up, monetary policy and fiscal policy, at least the monetary policy will be tightened by the central bank, and inflation will be brought down very quickly, then they will have low expectations of inflation, even though current inflation might be high. And then, of course, the long-run trend of inflation. Countries, for example, in Africa or now in Argentina. Argentina has, and countries in Africa have seen very, very high levels of inflation. And if you go back to the history of Vietnam during 2010, 2011, 2009, you will see that inflation was quite high too. But has since come down to a level of about 3%, 4%. So in countries where there is a history of inflation or a long-run trend of inflation, you expect to see higher inflationary expectations. But do we ever see inflation expectations? Do you know what the expected inflation in Vietnam is today? What is the expected inflation in Vietnam for 2026? What is by E 2026 for Vietnam? Sorry? Is it 3%, 4%, 5%, 7%, 1%, 0%?
Many ideas for that. Some person expect that it's about 7.
7 next year.
Yes.
Why?
Because it's based on the last period around, they move around 7.
What was inflation in Vietnam in 2024? 12-month inflation.
Remember.
Was it 4? I think less. Let's find out.
Yeah, 3 to 4.
And where do we go to find that out? Of course, we have a macroeconomic framework in which we collected all the data. And if you look at the selected economic indicators table, CPI inflation in Vietnam in 2024
Around 4.
looks like this, right? So if you take the inflation for the 12 months of 2024, or you take the CPI for Vietnam for the 12 months of 2024, take the average of 2023, then period average inflation is 3.7. If you look at December of 2024, compared to December of 2023, the number was 2.
Yeah. Also, back on my answer about the expectation.
Mm-hmm.
Yeah, because they, based on the last period, moving around 4, and
Okay.
then some happened during this year, 2025.
What happened in 2025 that was different from 2024?
Yeah, because they saw that many money supplied to the economy through investing in housing and many construction, many project along the country.
Mm-hmm.
So they saw that the money supply goes up,
Mm-hmm.
and they said the inflation will be higher.
Will be higher.
Yeah,
Okay.
so that's why some person, I just, not all, just some person, they saw money supply about money to the economy. So
Okay.
they
So
said
what
that,
they're saying is that
yeah,
things, if you are to, well, first of all, we have about 9 months of data for 2025. If you go to the NSO website, you will get data for January, February, March, April, I think on definitely till September. When the month of October is over, you will get the data for 10 months. So 10 months is already a lot of information in terms of what 2025 will look like. And if you go back and look at October, let's say September end, compared to September in 2024, you need to go and ask the question whether inflation is higher than 2.9 or less than 2.9. You can compare, you can look at the path of inflation over 12 months to find out whether inflationary pressures in 2025 were higher or lower. That you can definitely do. So your answer is essentially saying that there is an expectation about inflation which is higher than 2024, because already in 2024 inflation seems to be rising. So this was a low number, this was COVID. And after the economy boomed and came back from COVID, there was a lot of demand in the economy that was pent up, and that demand led to higher inflationary pressures. One can also go back and check whether oil prices or something like that went up at that point of time. What was the role of oil prices? And we can look at this global sheet to look at the price of oil. Okay? So look at the huge increase in the price of oil from COVID. That's a very large increase in the price of oil. So in 2022 and 2023, there was a 40% increase in the price of oil in the global economy. So the traded goods prices, or the price of a very good input into production, became very high after the global economy recovered from COVID, and that fed into inflation in Vietnam. What happened to the price of rice? Well, it fell, but then again it rose in 2023 by a very large amount. That's good for Vietnam in some senses, because Vietnam is an exporter of rice. At the same time, if rice has a higher price in the global market, there will be an impact of the price of rice in Vietnam as well, because more is being exported, less is available for domestic consumption. So in this year, it's quite possible that there was an impact of global rice prices on inflation in Vietnam. So looking at some basic things can give you an idea of why inflation in Vietnam might be high or low. So COVID was sort of like an external shock, where the demand curve in Vietnam is basically shifting to the left. Output is falling and and prices are falling or not rising by so much. And as the demand curve shifts out after COVID, you see a huge rebound in GDP growth because the economy is at a low level, comes back, and then you also see an increase in prices. At the same time, the world economy has come back from a very large shock. So demand everywhere in the global economy is going up. Oil is a very important input into production, so the price of commodities and oils begins to rise, and that increase in the price of commodities and oil in the global markets then comes back to Vietnam through the impact of the price of imported goods. That's basically what is happening.
I also want to add one point
Mhm.
about expectation of inflation next year. So it relates to the credibility of our government. And our government announced that we're in a period of development trust
Mhm.
and the past. And also we have IMF in Italy and London.
You have?
IMF, International Monetary.
International Financial Center
Yeah.
in Ho Chi Minh City.
Yeah.
Yeah, that is being set up. Okay, good.
And the government target the GDP for
10%.
10%.
Very low. Right? So if you think about, GDP growth in Vietnam has been what, 6%? If you increase the GDP, if you try to increase GDP growth by so much,
Inflation.
you would expect inflation to be higher. Unless something else happens, there's something else that offsets that inflationary pressures. Yes. Everything else being equal, you should expect slightly higher inflation in 2026 compared to 2025, whatever the number comes out. Good point. And this construction that you're saying one must be related to, some may be related to this, some may be the government is investing in infrastructure projects, building roads and stuff like that. That's where the growth is going to come from. They've reduced the number of civil servants in the economy, so that should reduce demand a little bit, unless all of those people find jobs in the private sector and earn income there. But many of those people, I was told, received large packets for leaving the government. Depending on how much they spend out of what they receive from the government, we may have higher inflationary pressures from a boost in spending because a lot of people got retirement money. You get your retirement money, you go for a vacation. Good ideas, right? So that's how you look at the numbers, then you ask the question, where are these numbers coming from and why am I getting these numbers? And where do I expect things to go in the future? For the future, we don't have numbers, but we have ideas about the kinds of things that will contribute to inflation. So we don't, well, in countries like the US, there are surveys that are conducted. So you go ask a bunch of people, what is your expectation for inflation next year? You collect the result of the survey and process it, and you get an idea about what expected inflation for next year is. In the case of the US, you also have certain financial instruments which are called indexed bonds. And those indexed bonds basically say, if inflation is high, then I will pay you a higher interest rate. So that I will protect you from inflation, that you will have a real rate of return of 5%. And these inflation indexed bonds can give you an idea about what expected inflation is. Because the return is supposed to be given 1 year from now, 2 years from now, 5 years from now. Okay. There is a guaranteed real rate of return, but implied in that nominal and real rate of return is an expectation of inflation. And we'll see more of this. So many countries, in fact, many advanced emerging countries, and certainly all industrial countries, do surveys on consumers or the population's expectations of inflation. And they can also ask people, why do you expect inflation to be going up? And they will get answers like you're giving. We expect that the government is going to raise growth next year because of this reason. There's a huge construction project going on next to my house, or a plant shut down next to my house, so we expect inflation to be going down because there's not going to be much income and expenditure in my neighborhood. So those kinds of things. What about tariffs? Donald Trump tariffs? So for the US, if he imposes 100% tariff on Chinese goods, my shirt and my shoes are going to become very expensive in the US. Right? Just about everything that you can buy from Amazon comes from made in China. So this is the augmented Phillips curve, which again you've seen in your macro courses, where we've included inflation inertia, adaptive expectations into the Phillips curve. We have expectations of inflation and it changes in the real marginal cost as a part of the Phillips curve. So here we have a situation where the real marginal cost is included in the Phillips curve. And what is the transmission mechanism through the real marginal cost curve? This is something that you've seen again in your macro courses. If demand rises, firms have to respond and produce more goods because there is market equilibrium. But firms can produce more only at a higher marginal cost because there are diminishing returns to production. The marginal cost curve is upward sloping, and if the firms have higher marginal costs, given that these are oligopolistic firms and they have profit margins to maintain, they will ask for higher prices. This is the mechanism through in your DSGE model, how marginal costs transmit into higher inflation. And in your DSGE models, for example, real marginal cost can be approximated by different things. And on the internal side, they can be approximated by some measure of wages. Right? And so remember the simple Phillips curve that we had earlier had the output gap in it. This is another version of the same Phillips curve where we don't have the output gap, but since we cannot observe real marginal cost, we say that the real marginal cost is related to the output gap. So if the output gap is low, if the economy is producing at more than full employment, then real marginal costs are expected to be high, and we can include as a proxy for the real marginal cost the output gap, which brings us back to the same old Phillips curve. In addition to that, we might have some measure of wages in the economy. So the real marginal cost is approximated by these things. In addition, if we have an open economy, right, we say that the exchange rate affects inflation. In your DSGE models, we can include what is called the real exchange rate gap on the right hand side as a determinant of inflation. Because we've already argued that if the prices of imported goods go up, if the exchange rate depreciates, inflation would be higher. And in that case, we would include some measure of the exchange rate into the Phillips curve. So what have we learned about inflation? This is what we learned about inflation. We've learned how to think about how is the CPI index constructed, how to interpret the CPI index, how to calculate inflation from the CPI index, how CPI inflation is different from the GDP deflator inflation. And after that, we said that we want to take out underlying pressures, we want to take out the volatile items from the CPI index to calculate a measure of underlying inflation, which we call core inflation. And we said that you can construct different measures of core inflation, and there are various issues related to the construction of core inflation. And finally, we looked at the determinants for inflation. Obviously, aggregate demand and aggregate supply fit in, and from a theoretical perspective, we have two ideas about what determines prices. The quantitative theory of money is essentially saying that in the long run, right, inflation is caused only by rate of growth of money. Something like that. The Phillips curve is a short-run relationship which gives inflation as a determinant of past inflation, which captures inertia, and of the output gap, which, if you have a fully fledged optimizing model with sort of firms, essentially is capturing the real marginal cost. And in addition to that, if we have an open economy, then we need to take into account the impact of exchange rates on inflation, and we can include that as part of the Phillips curve. And we looked at the role of expectations in inflation as well. Different countries construct different measures of core inflation. In the case of Canada, they exclude food, energy, and indirect taxes. In the case of the US, food and energy is usually excluded, but there are other measures also that are constructed by individual analysts. So you can see that this is very interesting. New Zealand, they exclude only interest charges. So different ways of constructing the CPI. Let's open the inflation file, which is on Moodle. We'll finish that, and then we can take a, well, let's see how much we can finish. So here is the CPI index for Vietnam on a monthly basis since 2010. Here is the annual CPI inflation. Let me allow you sort of 10 minutes to see if you can fill in these columns using the formulas up there. Once you do it, I will do it after you. Okay? After you finish it up, you should be able to finish in 2 minutes, then you can take a 10-minute break. I'm just joking.